Chapter 8, Part 1, we're going to look at the journal entries associated with periodic and perpetual inventory systems and trade and purchase discounts. Now, inventory overview. Inventory refers to assets a company intends to sell in the normal course of business, has in production for future sale, or has currently in production of goods to be sold. Cost of goods sold is the expense related to inventory. So again, when we buy goods, it goes into inventory, and when we sell it, it transfers to cost of goods sold, which is going to be on the income statement. Now, goods in transit. Where the goods are will determine how they're treated on the company's books. So, example is, accounting for goods in transit depends again on when ownership passes. If it's shipped FOB shipping point, it means title transfers at the point it leaves the seller's docks. So that means the minute it goes out the seller's door, it goes into the inventory of the buyer. Now, if it's shipped FOB destination, it doesn't go into the inventory of the buyer until it's received by the buyer. Goods on consignment stay in the inventory of the original company until it's sold to a third party by the person in the middle. So they have to keep it on their books until the person they gave it to sell for them physically sells it. Now, periodic inventory system. You adjust the inventory account and the records cost of goods sold only at the end of the reporting period. Records merchandise purchases, purchase returns, purchase discounts, and freight in temporary accounts. Determines periods cost of goods sold by taking a physical inventory and combining temporary accounts with the inventory account. So, to get cost of goods sold, it's beginning inventory, plus adjustments, which include the purchases, freight in, less any purchase returns and allowances, minus any inventory. Now, trade discounts. Trade discounts are when someone says something costs $100, but if you buy 10 of them, they cost $80. You would record $80. Purchase discounts are different. Purchase discounts, you're rewarded for paying early. So, there are two methods. The gross method, which means we record the total purchase price and view a discount not taken as part of the cost of inventory. Under the net method, you record the net of the discount. And if not paid within terms, the discount is treated as a purchase discount loss, and this is treated as an expense account. So, in our example right here, they purchased 1,000 units with a list price of $10. That cost them, because of the volume, $6 each, with terms 5% if they pay within 10 days, and they have to pay the balance in 30. So, for the gross method, and we're doing periodic, we put purchases at the gross amount, and if we paid within terms, we'd have purchase discount of $300, and that would reduce our inventory costs. If we paid after terms, then we would have no effect on our inventory because the original amount we put in was $6,000. What about the net method? Well, purchases would be adjusted for the early payment percentage, and if we paid within terms, that's how much cash we would have to pay. If we didn't, we'd have to pay the whole $6,000, and we'd have again that account called purchase discount loss, which can be part of other, like interest, or included in cost of goods sold. But remember, it's not included in inventory cost. Now, let's go through the journal entries for periodic. So, we bought $100,000 in goods. We would book purchases and accounts payable. We paid freight, which would be a separate account under the periodic system. We returned goods. We had another account called purchase returns and allowances. And we paid for the goods after terms, so it would be $100,000 minus the $5,000 returned. Never forget to subtract anything you've returned. That's a common mistake students make. cash would be 95, and then we sold 110,000 worth of goods. But remember, we cannot book cost of goods sold until month end when we do a physical inventory. So what does that look like? We start with our beginning, plus our purchases, plus our freight, minus our returns, tell us our total cost of goods available for sale is $116,300. We would subtract out $34,300, and that gives us cost of goods sold. Now, what we would do is, at the end of the month, we would zero out our cost of goods sold, book our cost of goods sold, and zero out our temporary accounts, and adjust our ending inventory to $34,300. So, cost of goods sold would be $82,000. We would increase our inventory to our new ending balance. We would zero out our purchase returns, zero out our freight in, zero out our purchases, and zero out our beginning inventory amount. Okay, so the accounts would be added up and then adjusted for ending inventory to cost of goods sold. Now what about Perpetual? Perpetual, we have a continual adjustment. We're going to adjust the inventory for every time we make a sale. So we're going to add purchases minus sales minus return of merchandise plus freight plus return by customer. Now these are all adjustments to the inventory account. They do not have separate accounts minus any purchase discount. So we're continually adjusting the cost of goods sold account each time goods are sold, returned. Okay, so now let's take a look at the same example. Using the gross method, we bought 100,000 goods. You notice we debit the inventory account. Paid freight, debit the inventory account. Now, what about our return? That also is a credit to inventory because it reduces our inventory. Now, pay for the balance of the goods purchased. And now what happens when we sell when cost of goods sold was $80,000? We're going to go accounts receivable, but we can also book our cost of goods sold and reduce inventory by $80,000. Determining ending inventory, we would start with beginning plus purchases plus inventory freight in minus purchase returns tells us we have a total of $116,300. All of these would have been adjustments to the inventory account. And we subtract our cost of goods sold, and that would be the balance in our inventory account. Now, perpetual versus periodic. Perpetual inventory, cost of goods available for sale is allocated by decreasing inventory and increase in cost. So you have a constant knowledge. So if you're doing financial reports, you're always going to know how you're doing. It facilitates the preparation of interim financial statements by providing fairly accurate information. However, Perpetual is expensive to implement and involves the tracking of both inventory quantities and costs. You have to keep track of both. Now, periodic is good if you have a small store where you don't have a lot of inventory because you're going to allocate cost of goods available for sale between ending inventory and cost of goods sold at the end of the period. I did consulting for a company. They did periodic inventory, did it every single day. So what they do is have people come in at night, go through, do a physical count, and update the inventory. And I want you to know is never right. Never. Because what would happen? People would pull inventory and leave it someplace. Doesn't mean it was sold. Because what would happen is customers would come to the counter. They'd say, oh, I want to see A, B, and C. They'd buy one. And the people at the counter were in a hurry, so they just stuff A and B under the counter. And no one would pay attention to it. But again, it's less costly to implement and constantly monitoring only quantities. We only look at quantities. And that ends this presentation.